Them see their money as a tool, a way to pursue their dreams and pursue their goals. I hope to always be a clear, accurate, and investable voice for all of our viewers. You'll learn a lot here at CNBC. It's also a lot of fun.
Everybody, I'm Sherry Kang in Hong Kong.
And good morning, folks. I'm Martin Sung in Singapore. These are your headlines this hour. We are bracing for a positive start out here in Asia. Futures stateside are continuing to edge higher on the back of one of the biggest rallies in Wall Street's history overnight, as U.S. President Donald Trump put reciprocal tariffs on hold for 90 days for countries that are willing to negotiate.
But China, not part of the deal. President Trump stepping up levies on Chinese goods to 125% following Beijing's retaliation, deepening the trade war between the world's two biggest economies.
And oil is extending gains after popping about 4% overnight. Its best day in months, in fact. President Trump's tariff U-turn helping to ease worries about a global recession and demand drawdown.
Markets in Japan, South Korea, as well as Australia coming online as we speak. And we've got green across the board. Kospi over in South Korea leading the gains higher by 4.5%. Of course, we are tracking the moves that we saw on Wall Street overnight as President Trump put a pause on tariffs, although he upped the number on China as well. And of course, when we're talking about this kind of moves, we need to be asking the questions around, can we trust this rally and what's happening with the pause, because it's only for 90 days. Let's quickly take a look at South Korean markets here. And I think this is an interesting one, obviously, not just the fact that we've got the leading gains coming through for the Kospi this morning. As we are celebrating this pause, I wonder what's going on in terms of the auto sector, for example, because the tariffs on auto is still intact, and perhaps we can show what's going on there in that particular space here. And hey, what do you know? We've got this solid gains coming through. Hyundai Motor higher by 6%. I would imagine sectors like semiconductors as well as shipbuilding, they could be, semiconductor and oil refiners, because they were really the sectors that were hit hard because of tariffs concerns and recession concerns. We've got SK Hynix surging 13% and Hanmi Semiconductor, so that is the supplier for the HBM supply chain, and that stock is also surging 15%. What about oil refiners, the likes of SK Innovation and S Oil, because we saw a big jump when it comes to Brent crude and WTI, and we've got a rally going on in this particular space. But of course, Marty, I am very much curious about the price action in the shipbuilder space, because we finally got that executive order from President Trump when it comes to revitalizing the U.S. shipbuilding space. And of course, this is a sector that was touted as a major Trump trade in South Korea. And we've got, yet another session of big rally coming through. Marty?
All right, good to know. All right. So let's get over to Tokyo. The market is about coming to 4 minutes into trade, opening up strong. But Lin, what about car makers there? Because, as Sherry was pointing out, those 25% tariffs are still on.
Yeah, indeed, that is the case. And all those major autos are yet to come online for trading because of the heavy price action that we are seeing in those early minutes, Martin. But if you look at the transport index, it is higher and it is outperforming the broader sectors as well, 4.4% higher in those opening minutes. Certainly, as you say, it is not part of those partial exemptions, but perhaps this is adding to the broader sentiment here among market participants that there could be a deal done on that front as well. We know, of course, that the top Japanese negotiators are in the US to try to come up with some sort of a deal. Now, I just wanted to note as well that we're expecting big uplift for the Nikkei 225 benchmark as well. It's already 3.7% higher. However, we saw just ahead of the open that those circuit breakers in terms of futures trading was enacted again. So it was a suspension in terms of the futures trade because we saw that those futures for the Nikkei 225 hit that limit of about 10% as well. We saw it on the way down as well last week. So we will wait for that to sort of warm up as the market action gets going as well. But, it is the sectors that have been battered really hard last week that I'm seeing sort of the biggest uplift in. So whether that is in terms of the financial sector, the banks, the securities, the insurers, they are getting a lot of bid as well. A lot of the sectors that Sherry also outlined in terms of those commodity exposed stocks as well, and also watching those shippers in Japan as well, perhaps not going to gain as much as perhaps their South Korean peers, but expecting an uplift there as well. Guys.
Thank you very much, Lynn, for that. And that brings us to today's big number. And that is, and we've been talking about this, 125%. The rate that President Trump said he is going to impose on Chinese imports because of what he calls a, quote, lack of respect that China has shown the world's markets. And all that while temporarily pausing other hefty country-specific tariffs. And, Marty, watching the developments just overnight, in the evening, we did see China's move to up the number of their number to 84%. And then we've got that announcement of 125% from President Trump on China. Obviously, it's kicking the issue down the road for about 3 months with other countries. But at least when it comes to China, I feel like President Trump made clear, some things are clear about China, because it sort of showed that it's very fundamental. I know that we're talking about the number itself, but I think what he wanted to do with all these tariffs on China was a little bit more fundamental, perhaps, that he wants to sort of keep this difficult negotiation going with China as well.
Yeah, I think you're absolutely right there, Sherry. And I think, the higher the number goes, he's hoping that it's going to push China ever closer to getting to the table and talking. He had some pretty positive words about Chinese President Xi Jinping, saying he's a smart guy and he's still confident that, the U.S. and China can come to a deal. So I think that's what that pressuring higher on the number could potentially be about. Sherry, it's going to be interesting to see, obviously, how Chinese markets react when they come online at 9:30, but also potentially what the policy response is going to be.
I think that is the biggest chatter in this part of the world, obviously. And, many are saying that China was sort of waiting to push that stimulus button until this moment, and maybe we'll get something to support its own market. And we've been seeing sort of this national team coming into the market as well. And then how about that yuan devaluation conversation? Could this number, big number of 125%, could it make the PBOC, more encouraged to go for, something more dramatic than what the market was primed for? Because remember, Marty, a lot of people, all our guests included, saying that they're going to go for something gradual. They don't want anything too sharp. Is that going to be the case? Could this number change the situation? We'll see.
Yeah, we shall see. And the time to see is 9:15 sharp Hong Kong Singapore time when they do that midpoint fix for the renminbi. So we'll be watching for that. And again, in terms of China's policy response, there have been reports, Sherry, that they've convened, I guess, their version of the so-called Trade War Council involving cabinet members, PBOC, finance ministry officials to talk about what they could do to stimulate the domestic economy. So that's something that CNBC's Evelyn Shang is keeping a very close eye on. We'll get up to her in Beijing, the Chinese capital, to talk more later this morning. So looking forward to that. Meantime, one of the economies that is not being spared all this the tariff impact is Singapore. the small island state, and JP Ong is out and about in the city-state. And if I'm not mistaken, going by where you are, I can sort of smell the salt air and feel the breeze. JP, you there?
Yeah, good morning, Martin. Yes, a bit crackly actually in my ear at the moment, but it is a good day to be outdoors, actually. A good day really to welcome to the markets because of the decision on that 90-day reprieve or that stay of execution on tariffs instituted by President Donald Trump. Now, we have to remember that the blanket tariffs of 10%, which were applied on Singapore as well, remain on board. So basically, there's not a lot of change, it seems, based on that particular tariff levels being imposed on goods that are getting out of this particular port in Singapore. It's important to note why this is important actually in the context of the Singaporean economy. We have to remember that this port and this berth actually that's part of Singapore's port network actually represents one of the busiest ports in the entire world. In fact, it is second just behind Shanghai in terms of the volume of containers that they handle on an annual basis. And of course, we know because of all these port services come in and out of Singapore, because of its importance as a transshipment hub for global trade and global supply chains, any tariffs, any dislocations of these supply chains would have impacted these ports quite significantly. We did hear from Prime Minister Lawrence Wong that the tariffs that are being imposed globally could have a knock-on effect on the Singaporean economy and that there was a risk actually of recession. It seems we're getting a bit of a pause at the moment, but remember, it's a pause right now, which means that in 90 days or maybe on day 91, these risks could come back very easily and thus also could give more reasons for consternation for Singaporean economic ministers, Martin and Sherry.
Yeah, and JP, we were just showing folks a table of the world's busiest ports. We only flashed that for a couple of milliseconds, but I actually had some time to look at it earlier. And it's interesting, 6 out of the top 10 ports worldwide, there you go, happen to be in China. So that's something to think about. But JP, our colleague Lorianne Larocco, stateside, has been talking about this clause called on the water. And it means that, ships that are leaving where you are, just behind you, the port of Singapore, right? By the time it gets to the U.S. with whatever it's carrying, right, it's going to take several weeks. And around about the end of May is when the tariffs actually kick in, meaning between now and then, right, there is still time for countries to negotiate with the U.S. You've been talking to shippers, I'm sure. What have they been telling you?
Well, the shippers right now and some of the businesses we've been talking to have indicated that at the moment there's still a lot of uncertainty and they're still not entirely sure what it's going to do to their cost bases and their ability to actually do business. Of course, now this gives them a little bit of breathing room here, Martin. But a lot of them still concerned actually about what this will mean because again, it hasn't been taken off the table. It's just giving companies and countries room to negotiate. I'm glad you brought up the fact that 6 of those ports, or those 10 busiest ports, are in China. 7 if you count Hong Kong actually, because we know ports don't operate in isolation. A lot of these ports actually operate within the network, and thus any sort of knock-on effect on a port will have an impact, or perhaps even a ripple effect on ports, especially ports that operate at the level or at the level of busyness that Singapore does actually. So again, that's something that a lot of the shippers are going to have to be contend with. A lot of businesses that operate out of Singapore as well. And this just gives them a little bit more breathing room, it seems, about 90 days or 3 months to actually think about what's going to happen to their businesses. But again, right now it seems that we've just created a new day, and we pushed out the day where we have to brace, as we've been saying on the show over the last 2 weeks.
All right, great coverage. Thank you, JP Ong, out and about near the port in Singapore. All right, we're going to continue keeping track of the fallout for companies. Later on the show, we'll talk with global clothing and apparel maker Lever Style about how the tariffs affect its business. Stay tuned. We're back in 2.
Singapore is deeply invested in the growth of Asia. We believe that Singapore will do well when our region does well.
The debt issue. We have a very severe supply-demand problem. That's a big deal.
And if you can't put the what and the how in a consistent, clear, and meaningful way, then you could end up with high levels of volatility and conflict.
No American voter will ever accuse Donald Trump of being weak on China.
The largest government, the largest economy, the biggest capital market in the world is now holding Bitcoin.
Sponsored by
The Philippines has been stuck in an infrastructure deficit for a number of decades. As should it not be attended to, it will continue to be our really number one roadblock to sustaining our economic growth. We focus our attention on power, gas, waste management, and water. For each one of those sectors, we try to address a fundamental need. When water is reliable, we have dependable energy, we treat our waste the way it should be treated. Certainly, we create an ecosystem that's more conducive to foreign direct investments and economic growth. Sustainability and growth for us are one. We get things done. We are relentless. We deliver that critical infrastructure. The challenges are significant, but we've created a team that's extremely talented, absolutely equipped to execute.
It was a really good quarter.
This growth was driven by transactions.
Before they talked to Wall Street, they talked to John Ford and Morgan Brannan. Closing bell overtime.
The Bond Report is brought to you by PIMCO.
Welcome back to Squawk Box Asia on a Thursday. Let's get a look at what's happening in the bond market and take a look at some of this pricing. I want to draw your attention more to the longer end of the curve there, the 10 430.16. So that has calmed down significantly. In fact, it was a big drop by about 20 basis points because that tenor had been as high as 4.5% overnight. The 30-year, similar story, in fact, probably even more dramatic. The long bond actually hit 5% before now calming down to 4.72 on the back of what was announced by President Trump, that pause in tariffs for 90 days and plus 125% tariffs on China. Let's get right to CNBC's Rick Santelli with the full bond market report.
Good morning, Asia, Australia, New Zealand. Well, one of the biggest reversals in equity history has the three major stock indices flying like rocket ships, and interest rates, they had huge ranges. But maybe the most important tell is that by the end of the session, two-year rates were up nearly 20 basis points, and 30-year bond yields were lower on the session. We were in the mid-60s on an intraday basis on the 2s to 10 spread, and late in the afternoon, it was pushing back down towards 40. Moves are huge. In the end, the process may be messy, but the president certainly seems to move in a very fluid fashion when market conditions change. Ultimately, maybe he gave a clue today to buy stocks, or maybe this was all because the bond market looked like it was having a bit of a hissy fit yesterday. But in the end, I can't tell you the reasons, and I'm not going to dabble in politics. Suffice it to say that two-year note yields certainly reflect a much different view on Fed and easing than it did just 24 hours ago. And to think that yields on a two-year note just several hours ago were at 3.7 before they zoomed up and traded all the way back up to over 4%. And that all happened in an hour. For tomorrow, well, we might have more volatility. We're looking at our March read on Consumer Price Index along with initial and continuing claims. Now, I could almost hear you out there saying all data in the rearview mirror is probably not very useful at this point, considering the market moves, the volatility, and the notion that there's a 90-day reprieve from the president for everybody except China to go back towards a 10% floor on tariffs. He has isolated China. Now, how this turns out and how we read data points, well, I think in certain ways we could compare this in a weird way to major weather conditions, hurricanes or fires that take out large swaths of important economies like California, where the data takes a while to get back. Well, I understand that this is more of a global effect, but maybe similar, that there was a week that's going to make much of the data not very useful. We may have to wait a quarter or more to really see the effects of what that 1 week of negative volatility did. But ultimately, no matter how you slice it, investors are much happier today than they were 24 hours ago. Reporting from the CME HQ, I'm Rick Santelli, CNBC Business News, Chicago.
The Bond Report is brought to you by PIMCO.
Economy, innovation, culture, exploration. Discover the vibrant pulse of China's economy and dive into the rich tapestry of its culture. Embark on a journey of exploration with Meet China. Here, your journey begins.
Ambition to me is the drive to succeed, to improve myself, and hopefully in doing so bring some good into the world. I wanted to be a trusted source on all things tech. I realized there was opportunities to tell stories across multiple platforms, so I learned, adapted, and created new roles.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange, CNBC.
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought that was the end of it.
To the C-suite.
I started on the factory floor, and here I am 35 years later.
The economist and author Dambisa Moyo.
A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
It's an important pivot. The question is, how long is this pivot and how much of a reversal is it? I think of it as this was a necessary step to calm markets, but it will not prove sufficient unless we go further.
And that was Mohamed El-Arian from Allianz there talking about U.S. President Trump's tariff reversal or pause. Some markets we're watching this morning, oil prices popping 4% on tariff relief. Right now, we've got the Brent at $65.70 and light crude at $62.72. And gold was also hit as people were trying to raise cash earlier this week and is coming back up above that $3,000 level. And taking a look at, of course, some other parts of the markets, Bitcoin recovering above that 82,000 mark there. So pretty much a rally across the board. Marty?
Yeah, Sherry, and I think that the headline price reaction is probably more in the bond market, how it reversed course after getting absolutely routed the last couple of sessions, but also, of course, that 12% jump on the NASDAQ overnight. So let's take a look at how it's translating out here into Asia. We've got the big markets, Japan and South Korea, about 22 minutes into Thursday trade, looking sharp. Korea's up 5%, call it. Tokyo is up almost 9%. Sydney trails, but still a useful 5.5% ahead. Let's bring in James Sullivan, head of Asia Pac Equity Research, JP Morgan, joining us live here at the SGX. Sully, great to see you. And always a pleasure having you on the show. So we're off to a good start, it looks like, and no surprise. How long is it good for, though?
So, look, there's clearly a lot to talk about today. I would approach it from a couple of different angles. Number one, this isn't the first U.S. administration to find that the bond market's going to take a view, and it's not going to be spun by political rhetoric. It's going to be spun by facts. And so this isn't the first time. We've seen it in the Clinton administration back in the 90s, and this is something that we've talked about on prior shows. So the market is coming to the table with a very real macroeconomic view in terms of the impact of these tariffs. Point number one, that's a positive because you're starting to see a reaction from the U.S. administration to market forces. So that's interesting. Number two, even if you assume...
Hold on,
please go ahead.
What is the end view that the market is taking right now when you've got yields as high as they are, right? And the situation is you've got bonds and stocks and dollar all selling off at the same time. Yep. If it were the conversation at the end point was recession, we wouldn't have the 10 at even where it is now, 430 or so.
So it depends on what the recession is driven by, right? And so the reason why we're starting to see such high correlation across asset classes is you're getting a unitary impulse that's driving recessionary fears, but at the same time, that's also driving significant inflationary fears, which is not a normal environment for recession, which is why you're seeing coordination across the asset classes. Tariffs at the end of the day raise prices and ultimately constrain economic growth. I mean, we can talk in more detail, but basic macroeconomic theory, tariffs are ultimately caused by a savings and investment gap. And so despite all of the rhetoric, again, macroeconomic 101 for any college course, you learn effective truisms in macroeconomics, and that is one of them. And so unless the United States addresses the gap that currently exists between the amount that the U.S. economy saves versus the incremental investment that's required, that's a problem. Now, to extend that thought just very, very quickly, if you increase savings, you're reducing consumption, which is negative for economic growth. If you're reducing investment, you're pulling down economic growth. So the punchline here is, if you actually want to be serious about reducing the trade deficit, by definition, the truism of macroeconomics is you will reduce U.S. economic growth for a period of time as you go through this adjustment cycle. And so it's great to see the bounce in markets today. I think we have to be a little bit cautious with how we want to look at this on a medium-term basis.
Okay, Sherry, come in on this.
Yeah, and I just want to point out that NASDAQ futures are actually, turning around a little bit. So indicating, it's early hours, but it's a flatlining, but really a reversal of what we saw just a couple of hours ago. So I do want to make a note of that. But, just going back to what you were saying, James, about the coordination across asset classes. So do you think it will eventually come off as economies are set to slow down and as we are trying to figure out what happens over the next 90 days?
It's a great question, Sherry, and it really comes down to the approach that the U.S. administration takes on tariffs. A couple different ways of looking at this. First and foremost, even if the tariff pause is extended beyond the current 90 days and you're only left with the 10% level, you're still looking at the highest effective tariffs out of the United States since the 1930s. That's not a great decade to comp to from a macroeconomics perspective. And so we need to keep that kind of in the mirror when we're thinking about market moves on a medium-term basis. If you see the imposition of higher tariffs, that will be inflationary for the U.S. consumer. And again, comes back to the conversation that Martin and I were just having in terms of the high correlation across asset classes. High tariffs lead to high correlation. That's dangerous for market participants.
So with the bull market, I guess, sort of being questioned and with a lot of U.S. assets being, sold off earlier this week, what was really the market's messaging that we don't want this kind of recession, man-made recession type and, with President Trump, looking like he got the message. What happens to the markets now? Do we, prefer equities, and which part of the markets would, come out as potential winner in all this?
So the fundamental question remains one that we've discussed on prior programs, which is this open question, what are tariffs actually for? If you have an across-the-board 10% tariffs, then tariffs can easily be argued to be for revenue generation. That's important given deficits in the U.S., in particular given the legislative priorities to extend the current tax cuts. If they are for revenue generation, then they're across the board, not particularly high relative to what we've looked at over the course of the past week. And I think markets can digest that in relatively strong fashion. If tariffs are to reorganize the global trade system, number one, it's very difficult to see it working from a macroeconomic theory perspective. Number two, that will be far more disruptive.
All right, James sold that thought. We're back in 2.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Good money.
Everything seemed legit until it wasn't.
Good times.
The lavish lifestyle, the houses that they're used to.
Fame, fortune, and fraud.
His stories were so good, they all fell for them.
American Greed on CNBC.
We're moving from the autopilot era of AI to co-pilot era of AI.
We are just at the dawn of the robotics age.
The more experience you give it, the more capability this AI model can achieve.
Hopefully improves productivity, and it doesn't displace more jobs than it creates.
How to maintain our humanity if we live more and more digital lives.
The new era of tech on CNBC.
I took my first journalism class in high school. It felt like a superpower. I find it really meaningful to reach new audiences, women, people of color, younger demographics. A lot of traditional financial advice might not take into consideration that people have debt or that rent is so expensive. To me, ambition means taking on new opportunities that take you out of your comfort zone, but help you learn and grow.
Quick check on markets currently trading in Asia at the moment is shaping up like this, and we've got green across the board. We've got that market rally sting going on as well moments ago. Nikkei 225 higher by 8%, and Kospi also rallying hard by 5%. Ditto for ASX 200 over in Australia. Remember, President Trump putting a pause on this country-specific tariffs, but China, though not part of the U.S. tariff pause, President Donald Trump raising a tariff on Chinese goods to 125% following Beijing's retaliation. And Emily is joining us to talk about, okay, so first of all, let's think about what China can do at this point. Because just as I was really thinking about that, we've got some lines from China's Commerce Ministry looking like it's finding a new friend over in Europe.
Well, it's been looking for friends everywhere. We got President Xi Jinping. He will be meeting with the Spanish Prime Minister come tomorrow. He's going to be there in Beijing. He also has a trip around Southeast Asia come next week. So we are going to be watching out for the response from China today. The reciprocal 84% tariffs that Beijing is going to be putting on the United States, that goes into effect today, April the 10th. We're going to be watching, of course, will this be a retaliation through the financial markets, or will Beijing, play the poker game and call or even raise on Trump's 125%? We don't know. That is a very high number. So if we talk about retaliation through the financial markets, of course, the market has been chattering about what's going on in the Treasury market, also in the yuan as well. As we all know, China is the second largest holder of U.S. Treasuries at $761 billion US dollars. Could they dump bonds to hit Washington? There is little evidence to show that they are going to be doing that. We're also going to be watching the Chinese currency. Will they devalue that? That would anger Trump, because that would, of course, then boost the dollar. The yuan is tightly controlled. It will be fixed by the PBOC. There is a daily fixing that happens at 9:15. We've seen the yuan, the CNY, fall 1.3% this month alone. That is the weakest in 17 years. And China, as we know, has preferred stability on its currency. So we are going to be, of course, watching out, looking out whether or not there is any financial retaliation in that regard in the financial markets. When we look at the market today, what's going to happen in China, Hong Kong? Well, we could see stability, a rebound. One for one, there is the national team. Of course, they've been on alert all week. And then if we look at some of the ADRs traded in the U.S. market, BABA is a good one. That was up 5.5%. So there was stability in one of Hong Kong's key heavyweight stocks. What we're also looking at now is this, the fact that the tariffs around on other countries, the 85 countries, have all now gone down to 10%. Yeah. This China plus one strategy now is back on the table. It could still work. Places like Vietnam. So we're going to be watching out for the logistics, the rerouting for motivation in terms of trade. Exporters will be in focus as well. And then there's the China stimulus. What are they going to be doing to boost domestic demand, really ramp up domestically their economy as well? So lots going on.
So just going back to the yuan devaluation, because there was this very subtle messaging that people are, thinking about here. So on Monday and Tuesday, it was very weak. And then on Wednesday, I believe that it was really just sort of it looked like PBOC wanted to keep things stable. Is that the takeaway that we should be getting? What's the chatter on the ground or some of the guests that you're talking to on your show?
Well, we saw the currency cross a 7.3. So just taking a look here at the CNY, I should say the CNH, which is traded in Hong Kong, the offshore, 7.3534. So it has continued to weaken by 0.1%. Stability, of course, is the name of the game when it comes to China. They won't do anything in terms of kind of like a quick reaction, if you will, in response to what's going to be coming through from President Trump and his, of course, trade team. So it really will, I'm really keen to know what he's going to do and whether or not any talk between the two presidents is potentially something that we could see. Martin, it's going to be a really interesting day on the market as we wait for the reaction, the first response to come through from Beijing today. Absolutely.
Happens at 9:30 a.m. Hong Kong, Singapore time when the market opens. And, of course, 15 minutes before that, you both were talking about the fix, the midpoint for the renminbi. Last couple of days, it has been softer in baby steps. But I think back to James Sullivan, J.P. Morgan, still with us here at the SGX, raises the question, does it increase the risk now that we're at 125% tariffs that a big one-off deval a la 2015 could be on the cards?
I think it's unlikely, given the fact that you'd have to pay the price for that within the Chinese domestic economy in terms of inflation. The odds that they will continue to manage it down and sterilize some impact of the tariffs through a weaker RMB, I think is very clear. The potential for a destabilizing move, I think, is unlikely.
Okay. So at 125 then, what is that going to mean for China's markets?
So one of the critical facts that we talk about with clients all the time in terms of China is we have to bifurcate the view of the economy versus the view of the equity market. So net exports represent about 19% of China GDP, but they only represent about 3% of top-line revenue for MSCI China from an index company perspective. So there's a very domestic orientation to the stock market in China relative to the broader economy. Obviously, you still have secondary impacts on consumer demand, and we have to factor that into earnings forecasts, but the direct effect is significantly less than it would appear at first glance.
Okay, Sherry, come in on this.
Yeah, and so are you saying, just going back to China, James, as long as the tariff war gets resolved, and we don't know how it's going to get resolved with the Trump administration, because China has been reorienting its economy more toward domestic consumption, that it could actually be a safe haven in your portfolio? And what kind of weighting would you carry for China?
No, it's a good question, and I guess a couple of facts to put on the table. Number one is we've gone throughout this incredibly volatile year-to-date period in markets. The only index prior to this morning that was up year-to-date was actually HSI. Everything else has been down significantly, 20% plus in Taiwan, Korea, et cetera. And so it actually has served as a significant safe haven for public market equity investors on a year-to-date basis. As you very rightly say, the equity market is very focused on domestic demand and domestic consumption. We've also seen, however, the Chinese government aggressively repurpose exports away from the United States and towards rest of world for the past 5 to 10 years. And so they have gotten a little bit ahead of this conversation. And so the odds of the China market holding up reasonably well, given very low valuations and still somewhat light ownership, not to the degree that we saw at the end of last year, but somewhat light ownership from institutional investors, I do think creates an attractive investment environment. The other market that we're looking at regionally is India, which we can discuss in more detail.
Yeah, so let's discuss India. What do you like there and why? And I wonder if I may throw in yet another question. How come none of these ally countries of the United States, like South Korea and Japan, are you not looking at them?
We are. I think there's different elements of the economies that we're looking at in each of those. So maybe India first, and then we can go to the allied nations second.
Sure.
If we look at the underlying high-frequency macroeconomic statistics coming out of India, we're seeing a lot of actually really good news. Industrial production is surprising on the upside. Cement production is surprising on the upside. CPI is actually coming in slightly lighter than expectation. And you're actually seeing a trade deficit that's the lowest in almost 4 years. So the high-frequency data coming out of India looks pretty good. If you do have a global slowdown and oil comes off, it's obviously up today, but it's been weaker over the course of the past couple of weeks. Weak oil is positive for broader Indian equities, given the way that market operates. So we do see a pretty attractive environment there, particularly in banks, which is an area that we've been focused on for some time. If I look separately at some of the allied countries, there's specific subsectors in each of these that we've been very focused on. In Korea, it's really been the military-industrial complex, where you're still seeing a basket of stocks that's up 50% year to date, even after the drawdown that we've seen over the course of the past 2 weeks. That's an area that we see significant strength. You mentioned earlier in the program the strength of Korean shipbuilders, particularly driven by incremental naval demand. So that's a sector that we remain very interested in as well. But it's very sector specific.
James, back to India just very quickly. Right? I wonder whether the tariff risk over India is actually lower than for a lot of other countries, a lot of other big Asian economies, simply because they seem to be a lot more proactive in terms of diplomacy, engaging the U.S., engaging the EU, engaging the UK about doing possible trade deals.
I think very much true. I think we also have to be cognizant that the structure of trade from India to the United States is very different than, let's say, China as an example, because of the services component. And the one aspect that we haven't spent a lot of time talking about is the fact that the U.S. administration is almost entirely focused on trade in goods, not trade in services, where the U.S. actually has a surplus. If that narrative starts to shift, we have to recognize that the large majority of Indian exports to the United States are IT services. Those stocks have taken a significant hit due to the risk of recession in the United States and the lack of corporate expenditure that would then hit the IT services top line. But it's really the nature of goods versus services, India versus China, that we're very focused on.
Yeah. Do you think it will creep over, leak into services?
We're starting to see commentary from some countries around the world, particularly in Europe, which is potentially targeting services primarily in the tech sector, where the U.S. enjoys significant competitive advantage. So we have to see where this tit-for-tat environment goes from here. There are significant tools that countries outside the U.S. have access to, which would be pretty damaging for targeted U.S. corporates, and so we have to watch that very closely.
Okay, we'll do.
And let's bring it back to the AI conversation here, because we were already seeing this AI digestion phase, and AI trades were already being tested even before the tariff war really started in earnest. So looking at APAC, is there any particular sector that we need to be watching? I guess the narrative has been going into 2025, James, is software versus hardware. Is that staying intact?
It is, and we've talked on prior programs in terms of sort of the evolution of the AI trade. I think we're still in the early innings of the hardware trade. You have seen a significant bifurcation of supply chains, China versus U.S., and you are seeing significant incremental investment coming out of both centers of investment. Some of the recent corporate headlines out of the U.S. from major tech players have reiterated their commitment to that. So we do think that will continue. At some point towards the tail end of this year, you start to segue over into enabling software and services that will enable productivity gains off of that hardware stack. We don't think we're quite there yet, but towards the end of this year, we think we see significant rotational trades that we're very interested in.
What about outside of semis? What do you like in hardware? I mean, because we've been seeing this massive run in at least the South Korean markets when it comes to power equipment makers. Are they looking richly valued, or do you see a play there?
If one assumes that the ongoing capex in the AI space continues, then I think that the demand function remains intact for electric grid, power, et cetera. The sector that's most at risk, particularly from a tariff conversation, would very clearly be smartphones and consumer electronics. That's an area where we're increasingly getting a little bit nervous in terms of demand if tariffs continue to push higher.
And today is the day that we finally got to President Trump's executive order on shipbuilding. And of course, this is really competition with China and also trying to boost the Navy in the United States. On that note, I remember you making this call months ago, even maybe a year and a half ago, on South Korea as a shipbuilder. And you did say that you're still interested in them. But what about valuations? And is this the right time to deploy fresh cash in South Korea as a shipbuilding?
We think it is for a variety of reasons. Number one, Korea is one of the only countries globally that can sell into both NATO as well as the United States. The Trump administration has very clearly indicated a desire to rebuild the U.S. Navy. The amount of shipyard capacity that exists within the U.S. to accomplish that goal is really de minimis, and so that's going to fall primarily on Korea yards. And the incremental demand function can drive very, very significant incremental revenue relative to current forecasts. So yes, the stocks have performed. Yes, valuations look punchy on current forecasts. But if this incremental demand comes in, then we see 50-60% upside to top line from here.
Yeah, and on this whole issue of shipbuilding, Sully, I mean, this is obviously business, it's commercial, it's industrial, it's also national security, because the numbers I've seen, and I'm not sure what numbers you're working with, but, China's advantage over the U.S. in shipbuilding is about 200 to 1 right now.
Correct.
That's how bad it is.
There's almost no high-end shipbuilding capacity that exists within the United States right now, because for a whole variety of reasons, inclusive of something called the Jones Act, which is a much longer conversation.
Yeah.
But at the end of the day, it is not cost effective to build vessels in the United States, and so Korea will be the incremental primary
What about
beneficiary.
Japan, though?
We don't have as much capacity in Japan as we have relative to Korea. It's really China, which is the behemoth, Korea, which is scaled and large enough to matter, and then Japan slightly smaller than that.
Okay, gotcha. Sully, listen, pleasure talking as always. Thank you so much for dropping by. Keep safe and come see us again soon.
Sounds good.
All right, pleasure is ours. James Sullivan there, JP Morgan, joining us live this morning. All right, as we tail into a break, take a look at some of the biggest winners up in Tokyo so far this Thursday morning. We're right back.
At Interactive Brokers, independent RIAs work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for Advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
We are learning how to use AI day by day, and it is a very, very interesting new opportunity space, obviously impacting every industry. And as such, it influences the way how people search for information, how they consume information. It's a very important part of decision making. So understanding how retrieval augmented generation works and how we can influence it in a positive way for us is essential for every organization conveying information. We run sentiment analysis. We do a lot of number crunching to understand patterns, to improve our forecasting capabilities, and directly feed it into our marketing campaigns, and also do basically real-time monitoring of our marketing activities.
You're French, the son of two physicians, grew up in a family where you're focused on medicine and life sciences. How would you describe your leadership and your management style?
I'm very collaborative. I don't like consensus, which was something we changed.
You don't
in
like
the company.
consensus?
No, because I think that consensus is slow first, but also sometimes impossible to reach when you have a tough decision to make. So often everybody agrees, but if there is no consensus, it's not a reason for not making a decision. So very collaborative. I try to have a lot of proximity with people. I am very approachable. I want to be very inclusive. I empower a lot the Takeda executive team. So again, I think creating a culture of performance, but respect and inclusion and collaborative.
Welcome back. Thursday morning here on Squawk Box Asia. So we've been talking about the 90-day pause on tariffs announced by President Trump overnight. That has A, calmed markets, but B, that is also giving countries who are willing time to negotiate with the U.S. And it's exactly what's happening between the U.S. and Vietnam. They've agreed to embark on negotiations for a free trade agreement. The two sides are considering scrapping as many non-tariff barriers as possible. Now, according to the Vietnamese government, the announcement comes just hours after Trump paused the 46% tariff rate on Vietnamese goods for, again, 90 days or about 3 months. All right, let's head back out to JP Ong. He's on the ground near near the port in Singapore. And JP, that tariff pause I just talked about did bring some relief, but you know the thing is, I think people are forgetting the uncertainty has not gone away. It's still there.
Absolutely, Martin, and you're right. We're about a 300-meter swim away from one of these berths, and I can bet you that a lot of these ships that are out there are breathing a bit of a sigh of relief because they're getting a bit more breathing room, 90 days to be exact, with regards to the decision to pause these tariffs. Now, important to note that the goods from Singapore will still have that 10% blanket tariff, but again, that's the lowest of the tariff measures that any country can actually encounter. But it's also important to note that apart from Singapore being one of the busiest ports in the world, this is also a hub for supply chain management and logistics. And supply chain managers, shippers, logistics providers, they have had a very, very challenging last 5 years. If you recall, just 5 years ago, they had to deal with the onslaught of the COVID-19 pandemic. And 5 years ago, this coastline would have been littered with about 10 times the number of ships waiting for berths because of the congestion, because of the challenges of managing that pandemic brought onto them. This made them come up with innovative solutions. And just when you thought they had about a year to breathe, suddenly the tariffs caught them online, and thus causing more sleepless nights and consternation among them. What's important to highlight here is that once again, we have highlighted or emphasized just how important, how crucial supply chain managers and logistics providers are going to be to solving the new dislocations that we might see from global supply chains. But again, it also highlights just how complex this new set of problems are and how different they're going to be from what they dealt with 5 years ago with the COVID-19 pandemic, and definitely something that will be keeping a lot of them actually on their toes, and perhaps also making sure that they actually shine or put their best foot forward in trying to find these solutions, Martin.
Okay, JP, stay right there. Talk supply chain more and bring in Javier Bilbao, CEO of DHL Supply Chain Asia Pacific, joining me here at the SGX. Javier, good morning, and thank you for your time. And it's a pleasure. You know, JP and I have been talking about for the shippers, right, the folks who move stuff by sea, there's something called the on the water clause, which I'm sure you're familiar with, right? And essentially what it says is once the ship leaves port, right, tariffs are not in effect until it reaches the other side. And ships take quite a while. So, you know, for ships out here in Asia to get to, let's say, the U.S., I think now the date to watch is probably sometime in late May. And that leaves room for a time for negotiations as well. DHL, though, your business is less sea and more air and land. So do you have, I mean, does it affect you positively in any way?
It's very uncertain times, as has been described. It's affecting us in one way, and well, in multiple ways. Volumes will have an impact, but we also are the largest company trading across the world with a lot of presence in many different countries. And, you know, we provide also the customs brokerage services. We also help with, you know, reshifting of stock movements between different countries as companies continue to work on resilience, etc. So, yes, we will see an impact, which we're trying to measure right now, but there are positive moves in some directions, negative in some others. And as the announcement of yesterday proves, whatever decision you take today, you have to be very cautious that you might reverse immediately.
Tomorrow, right? So as a result of what's going on with the U.S., right, in tariffs, trade is going to slow, right? Values are going to decrease. Your business is probably going to be under pressure as well. Is there any sort of way to play defense? How do you deal with a situation like this?
You know, one important thing to bear in mind is that trade with the U.S. is very relevant, but it's only a fraction of the total trade that we see overall. A way to play on that is knowing that the U.S. is a very strong part of our business. It's not as large as it is with other competitors of ours. We are very widely present in markets like Asia, Europe, Latin America, and there is a lot of flows that are going to reshift. You know, trade will be resilient. We have seen, as JP was describing earlier, a lot of change over the last few years. It's not just tariffs. It's not just COVID. We had the war in Ukraine. We had the Suez Canal. We had the Red Sea. And recently, you know, all the developments on artificial intelligence, everything that we heard about ChatGPT, then DeepSeek, the speed at which everything is changing is phenomenal.
Yeah.
And we are a company that thrives in complexity.
Yeah, and adapting. Yeah, understood. JP, comment on this.
Absolutely. Mr. Bilbao, I want to know what your clients have been asking you about all the changes over the last couple of weeks, because as we mentioned, almost every meal, breakfast, lunch, or dinner, there seems to be a new change with regards to the tariff regime, how it might dislocate certain supply chains. What have your clients been asking you with regards to what's been changing, and what are some of the consternations they've raised with DHL?
You know, the positive side is that we have known for a period of time that these changes could be coming. not in the exact nature, but that there was going to be change in the tariffs, etc. So we've been working to prepare ourselves, all our databases, all our modeling tools, etc., to be ready for the change and to make sure that when these tariffs come into place, that we have all our systems ready to execute on the changes and make sure that the flows of our customers remain solid and resilient. So a lot of the questions are making sure that all of this is into place, and there's been a lot of questions as well as how flexible we can be in adjusting the location, in adjusting the flows. Being present in so many countries as we are, with all the capabilities that we have, for example, in free trade zones, and the investments that we've been making in recent years across, I would say, the world, but particularly as my area of responsibility, DHL supply chain in Asia Pacific. We've been investing in new warehouses. We have ahead of the need capability to help our customers move their stock between countries as they need. And as they are thinking that they need to reshift also their countries of focus, being able to provide responses in an increased amount of trade that will probably happen in all the flows that do not touch the U.S. today.
Right. One thing we've also noted, Mr. Bilbao, is that the tariffs on China have not just remained, but also have risen. And as we've noted, shipping ports, logistics hubs, they don't operate in a vacuum. You compete and collaborate with each other. How might the changes and the continued pressure release on China perhaps affected the outlook for business in other logistics hubs that you operate in Asia Pacific, either for better or worse?
I think immediately we're not seeing a massive change, and I think it will take a time because supply chains are not easily shifted from one moment to another. There's a lot of dependency between economies, and the investments that you need to make to move capacity, the interdependency of manufacturing factories, etc., on trade between the countries, you can't change that in a second. So right now, if we think about a situation where those tariffs with China remain, we could certainly see a big shift in those volumes over time. But who knows if in a week or so, China and the US get together again and look at a different scenario. So you can imagine companies that are needing to make decisions around multi-billion investments in factories, they can't change, every week where that strategy is taking them. So we're seeing a pause for now. Probably the most immediate impact is long-term investment decisions now are taking a bit of a rest. But anything that is already in motion, it's very difficult to change short-term.
Javier, I'm sure you, like a lot of other people, are agreed on the view that going forward, if the situation remains the way it is, the rest of the world's going to go, okay, fine, U.S., if you're going to be like that, that's okay, fine. I'll just trade with my friends here, people that I do get along with, right? So China and the rest of Asia, for that matter, the rest of the world. If that is the case, what does that mean for your business? And, all this isn't going to replace the U.S. I mean, it is that consequential a consumer market, isn't it?
It is not going to replace the U.S., but we have seen in recent years a lot more growth in flows between other parts of the world. The trade between China and the U.S., probably as a consequence of the first changes during the first Trump administration, had already started to decline. Yeah. Now they represent less than 3% of the total flows in the world.
Okay. Javier, great to talk to you. Thank you so much for dropping by. It's a pleasure. Come back, see us again very soon.
My pleasure. Thank
Pleasure is ours. Javier Bilbao there from DHL Supply Chain Asia Pacific. And we'll get back to JP on a little later on. We'll take a quick break. We're back in 2.
Singapore is deeply invested in the growth of Asia. We believe that Singapore will do well when our region does well.
The debt issue. We have a very severe supply-demand problem. That's a big deal.
And if you can't put the what and the how in a consistent, clear, and meaningful way, then you could end up with high levels of volatility and conflict.
No American voter will ever accuse Donald Trump of being weak on China.
The largest government, the largest economy, the biggest capital market in the world is now holding Bitcoin.
Sponsored by...
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Today is National Beer Day. Everyone with a 401k has been celebrating since last Wednesday.
Jimmy has the voices, Adam Levine, Bella Ramsey with a rap roundup.
That's a season 1 recap of The Last of Us.
And from the White Lotus, Sam Neville. This weekend.
It has just gone 9 sharp Hong Kong, Singapore time. The Singapore market just joining Thursday trade, opening up. Take a look. Strong 7.5% pop. Good morning. I'm Martin Sung at the SGX.
And I'm Shara Kang in Hong Kong. Your headlines this hour. Asian markets staging a strong rebound following one of the biggest rallies in Wall Street's history as U.S. President Donald Trump puts reciprocal tariffs on hold for countries that are willing to negotiate.
Here's the problem, though. China is not part of that deal. President Trump stepping up tariffs on Chinese goods instead to 125% now, with effect immediately after Beijing's retaliation, deepening the trade war between the world's two biggest economies.
All eyes on China's daily yuan fix due in 15 minutes from now. We're also waiting for the country's latest inflation data set to drop in 30 minutes to see if China is still facing persistent deflationary pressures.
All right, let's get right to market action, or rather reaction, after that huge rebound on Wall Street overnight. How are we shaping up out here in Asia? Well, take a look behind me. The Singapore market, just seconds into trade, about 90 seconds, is up 8.5% already. The Malaysia market is up more than 4.5%. Taiwan is coming back very strongly. It's up more than 9% right now. I want to show you the big markets as well. They've been up and running for about an hour, and here's the price action there. You've got Korea up 5%, Tokyo up close to 9%, and Sydney is up more than 5% as well, Sherry.
And we are less than 30 minutes away from China's market open. There's going to be a lot of attention on how they reacted to U.S. tariffs on China that just went up to 125%. CNBC's Evelyn Chang is joining us live from Beijing. Evelyn, I mean, there have been a lot of reports that China convened, I guess, their version of a trade war council?
Right. Well, we haven't heard exactly whether or not the heads of various ministries have met, but Chinese Premier Li Qiang did hold a meeting yesterday afternoon with several experts, including Shen Zhenguang from JD, who was on the China Connection earlier this week. And the premier basically stressed that those are external shocks they need to be prepared for. China is getting ready and has measures that they can take. We'll be getting some early reads on China's first quarter data in the next couple days, including the first quarter GDP next Wednesday. So they're getting ready for how the economy is going to be impacted by these latest tariffs. We've seen the retaliatory measures from China, basically tit for tat, adding new tariffs on U.S. imports. But the catch is that the customs agency is saying that if the ships have left the U.S. before 12:01 p.m. today, China time, then they will be exempt from the 84% in tariffs until mid-May. but it remains to be seen, how China is going to react to the latest increase in tariffs from Trump. The Chinese side has also released a huge white paper stating their position on the relations with the U.S. on trade, and it's basically laying out how this is a situation that is hurting both China and the U.S. They've also named some U.S. companies. Tesla, again, is a poster child for how China thinks U.S. companies could do business in China and be an influence in global economies, in the U.S. Political system. And there are also criticisms of how the U.S. has not apparently lived up to some of its commitments on the Phase 1 trade deal, including the tech restrictions and also China emphasizing again that it is trying to stabilize the yuan. But as we've seen in the last couple days, there has been a significant weakening there.
Yeah, we'll be watching that RMB fix coming up at 9:15, as always on weekdays, Evelyn. But, overnight we had the president, while he was upping tariffs to 125% on China, also describing President Xi Jinping as a smart man and talking very positive and saying, look, at some stage he's hoping to still have a deal, to do a deal with the U.S. and China, between the U.S. and China. Are there any signs yet that China is even thinking about or considering engaging with the U.S. and negotiating and talking, or are they more focused on battening down the hatches and providing support for the economy, especially consumption?
So China is still floating the signal that they want to negotiate, but more and more we've been hearing this harder stance, whether it's on Chinese social media, off-the-record conversations. China is really going to double down on boosting its own economy. I mean, it's clear that the U.S. seems to think that adding more and more tariffs on China is the way to go, and China is really thinking that there's nothing it can do to really reach some sort of agreement with the U.S. in the near time. And in the meantime, China's trade has been growing much more with Southeast Asia, with the European Union. In fact, there was even a call between China and the EU just a couple hours ago. So there's more and more, China can be trading with other countries. It doesn't necessarily have to rely as much on the U.S. market. But in terms of the near-term economic impact, of course, the U.S. is still China's largest trading partner on a single country basis. So there's definitely going to be some impact. Who's going to bear the cost of these tariffs? Remains to be seen whether China is going to support its exporters and potentially release more stimulus for the domestic economy, which has been struggling, and we'll get some more details on the inflation data on how much demand potentially has picked up domestically.
Okay, thanks, Evelyn. Great coverage. Appreciate it. And we'll be continuing to track China's response and reaction coming up a little later on this morning in our new show, The China Connection, with Emily Shantan. Plus, if you want a deeper dive into Greater China, all you have to do is sign up for our China Connection newsletter using the QR code right there on your screen. Go there and do that. Let's bring in Harold Vanderlinde, head of equity strategy Asia Pacific at HSBC Global Research, joining us live around the desk here at the SGX. Harold, great to see you, and always a pleasure having you on the show. Quickly, your reaction to literally just a stunning turnaround or reversal by President Trump overnight.
Yes, that's a good question. And I'm not quite sure how to answer it. I mean, I woke up very early this morning, looked at my screen and saw that the market was up, almost 10%, right? So a lot of big changes. The way we've approached markets over the last couple of days is to look at different scenarios that could unfold. We actually had 4 scenarios. One extreme, that markets would fall a lot further. One which is seemingly unfolding at the moment, that there's some sort of step back, you could say. And then 2 scenarios in between, and we're still working on that. I don't know how that exactly is going to play out. We can't throw the other 3 scenarios out of the window yet. But we'll see a big bounce in markets as we speak. We'll be interested to see how China is going to open up as well. But we do have to step back and say, listen, uncertainty in the world has increased. This will impact, for example, investments going forward, also in the US. This is going to still impact trade flows across the region as well. So that's something that we really need to think through a little bit deeper as well.
Yeah, strategy, Harold, talk to us about that, because one thing we're watching coming up in about 7 minutes, in fact, 9:15, is that RMB fix, right, the midpoint. Over the last couple of days, they've taken baby steps to soften it, right? But now that, boom, overnight, tariffs up to 125%, you've got to think that there's now a higher risk that potentially China could turn to the currency and maybe trigger a big one-off devaluation a la 2015. What do you think? No?
I would be very surprised if that happens, because what will be the consequences of that? If they weaken their currency, other countries will need to weaken as well. If you're a small open economy, you're going
to kill everybody else.
Exactly. Yeah. So if you're a small open economy, you can actually depreciate your currency, and then you become more competitive versus other ones. But China is so big that if it moves, all the other ones have to follow as well. So in the end, you're not really gaining too much out of this. You're only creating much more uncertainty. Also, you're putting pressure on all these other economies that you would like to trade with. Much more so. So I suspect that they're going to keep this. Maybe it will be a little bit weaker, but nothing too dramatic on this.
Now, I know you're an equity guy, right? But I noticed that there was an auction of 10-year bonds in the U.S. Yesterday, and a lot of attention was on that because the 3-year auction earlier didn't go so well, right? So the 10-year was very, very much in focus to the key, especially demand from outside buyers, including potentially China, right? Which is probably the biggest holder of U.S. Treasury's foreign holdings. The indirect bid turned out to be record demand. It was good. So it looks as though the potential for China to weaponize their holdings of U.S. Treasuries, we don't need to worry about that just yet either. Was that fair?
Exactly, because it is very easy to say, well, China holds a lot of treasury, so they can sell it. Yeah. And we've seen some odd movements in the fixed income markets that I struggle to really explain. And people have said, well, maybe China is selling. It could also be other funds. I honestly don't know. Yeah. But what are they going to buy? I mean, it's very easy to say, I'm going to sell, but you need to buy something. If you sell Singapore dollar, you have to buy something else.
They've been buying crypto.
But these markets, in the end, are relatively small compared to the size of the treasury market. It's so big. So if they would buy it and say, okay, we'll put it back into China, yes, then you have an appreciating renminbi. Well, it's not something that we see at the moment, but then you actually move in the opposite direction. Okay. So in a sense, you're really, to a certain extent, a little bit stuck. These are such a large, big market. Yeah. You can't just say, I'm going to move somewhere else that easily.
Okay, fair enough. Sherry, come in on this.
Yeah, and back to Asia and back to equities, Harold. Does this open up more policy room, especially in markets like China? Because some people were saying that China was waiting for this kind of moment to really go aggressive with the stimulus. Is that part of your projection?
Well, we've since late last year they talked about stimulus, and it really, that was the talk in what was November, December, was, well, China's holding off, is going to see what the US is going to do in order for it to formulate its domestic response. And we're probably going to see this now. If these tariffs stay in place between the US and China, it's 125% now, that means that trade between China and the US will, they will diminish, if not go to zero, right? So if you write that off, that is a chunk of GDP growth that will fall away. So they need to do some on the domestic side in order to keep their growth rates where they are, or allow GDP to really come down, or GDP growth to really come down this year. So I suspect they're going to do and respond to this. And there are effectively two responses. One is a fiscal response that you can put in place. So we'll see if they're going to do something on that particular front. There was some talk in the markets yesterday to do that. And the other is, of course, to look for trade partners elsewhere in the world. And it's very interesting. I understand that the Chinese leadership is going to visit ASEAN quite soon, before the end of this month, if I'm not mistaken. And there seem to be talks between Europe and China taking place, or have just taken place quite recently as well. So we see a realignment of sort of trade flows around the world taking place as we watch the screens.
Yeah, just moments ago, China and the EU side are discussing trade, and they're going to resume their EV-related dialogue as well. So impeccable timing, I would say. But Harold, hold that thought. We'll come back to you in just a few minutes. Harold Vanderland from HSBC is staying with us. And as we tail out, let's leave you with a look at the price action in TSMC hitting limit up after rising 10% there It's propelling the tech-heavy TAIEX index. Right now, the Taiwan index is trading up by more than 9%. Quick break on Squawk Box Asia. We'll be right back.
We're sitting ducks, waiting for them to infiltrate our defenses. Millions of tries, and they're in. Uh-oh, this one's in the code.
Today's Most Active Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Most Active Stocks Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Channel Japan, from the economy and technology to culture. Japan is fast becoming an international destination for travel, study, work, leisure, and living. What draws people to the country?
Biggest secret is Japan itself.
This country is so popular internationally is that anyone can enjoy it their own way.
Channel Japan, produced by Nikkei, the leading source for Japanese news and information.
See you next time.
My desire to keep learning, that is what drives my ambition. I sought a career change after 5 years working in corporate law to pursue a passion, which is to tell people stories and help our audiences make sense of the world that we live in.
Scott Wapner from the NYSE. Closing bell, CNBC.
Welcome back, Squawk Box Asia on a Thursday, and we're focusing on the Chinese currency right now because it's just gone 9:15. When, as always on weekdays, China fixes the midpoint for the renminbi. That is just out. It's at 720.92 versus the last close of 734.45. As you can see, the reaction right now, we've got spot at 34.99, offshore H's at 36.10, and forwards 1 year NDFs at 17.40. The offshore is something that we've been following very closely. At one stage, not so long ago, I think it was yesterday, we were down about 740 on dollar China on the offshore. So that's out of the way. Let's take a look at what is so far a rip-snorting rally in Asian equity markets on the back of probably one of the strongest days on Wall Street in history. We had the Nasdaq up, remember, 12%. That's right, 12%. The follow-through is pretty significant out here in Asia. The big markets, you've got Tokyo up 8%. Korea is up just under 5%. Taiwan, and this is a market which has been under tremendous pressure, losses of 10% or so. It is coming back. It's up a little bit more than 9% as we speak. Sherry?
Yeah, and I'm just looking at the CNH yuan move for the session. It's sort of locked in, of course, in this range between 3.75 and 7.36 at the moment. But the dollar did shoot up in the last few minutes or so, so that is quite interesting as well. But let's head back to JP Ong, who is out and about this morning, reporting near the Singapore port. And JP, we're trying to figure out what is the next move from Beijing here. And you were telling me that Xi Jinping is, I don't know, they were just talking to European counterparts, and now Xi Jinping is visiting Malaysia, Cambodia, and Thailand. What could come out of that?
Well, okay, sure. So the plan right now is for Xi Jinping, the president of China, to do a bit of what we call a house call across ASEAN, because he's visiting 3 countries starting on Tuesday, April 15. The first port of call will be Malaysia. Then he'll be visiting the countries of Vietnam and Cambodia afterwards, perhaps to discuss trade issues and, of course, some of the trade tariffs that have been imposed on China, and some of these countries that have now gotten a 90-day reprieve, with the exception of China, that is, will, of course, be on topic, of course. Now, Malaysia, on their part, actually, the government itself has said that this is part of a call to try and deepen their economic and trade ties with China. But, of course, they do want to discuss this because, as we know, Malaysia is the chair, holds the ASEAN chair at the moment, and their Prime Minister Anwar Ibrahim has said that there is a need for ASEAN or Southeast Asia to mount a bloc or regional response actually to these tariffs and to show a united front. This, as we've discussed in previous times, has been more challenging for ASEAN actually to act as a cohesive bloc. But this time around, there could be very precarious times that will call for very, very strong measures. And perhaps this could be that glue that will bring people together. But again, one of the interesting things, too, is just noting that there is an effort now to make sure that that ties, at least with Beijing, and ties with China, the world's second largest economy, which is now the biggest trading partner for many of these Southeast Asian countries, will indeed be maintained and perhaps even reaffirmed. Because even China at the moment, despite the very strong response to the U.S. tariffs, remains in a rather fragile state, and they will need to make sure that the other economic levers and economic relations are maintained and kept firm. Sherry.
Yeah, and JP, I think in times like this, right, you need to be very careful with the optics, what kind of messaging that you could be sending out in terms of who you're meeting, saying hello to, visiting, and shaking hands with. Because what we're seeing in Southeast Asian countries like Vietnam is very different from countries like Japan and South Korea. I know that there is a talk of the 3-way free trade agreement between China, South Korea, and Japan, but we just heard from South Korean acting president that we're not going to be ganging up against the U.S. tariffs and, sort of band together with countries like China and Japan. Do you see some sort of discrepancy in how Southeast Asian countries are dealing with all this?
Well, that's a good question, Sherry, but I think the answer there might be no. There will not be a defiant front against the tariffs levied by the United States, because as many of these countries in Southeast Asia have voiced out in the last couple of days, really there's not much more they can do. Now, apart from really just calling out and saying that these are not the actions of a true friend, this is something that Prime Minister here, Lawrence Wong, has echoed. This is something that Prime Minister Anwar Ibrahim of Malaysia has also said, but they've always followed that up with saying, hey, you know what, there's not much we can do. We can just hope for firm and fair negotiations. We will represent our side. But again, there's not much wiggle room, or really room, at least, at this poker table. They don't have the strong cards, actually, to try and at least pressure the United States. And even if ASEAN comes together and mounts a cohesive front, it's seen as being perhaps the option of last resort, and perhaps something none of the countries or collectively as a bloc will be considering anytime soon, Sherry.
Thank you very much, JP, and I don't know, enjoy the breeze if you got some there. Have fun out there. And we'll talk more about supply chain with Stanley Sito, chairman of Hong Kong-listed Lever Style, a global clothing and apparel manufacturer. It gets more than half of its annual revenue from the United States, but makes all of its products here in Asia. So Trump's tariff policy could make or break its business. Don't miss that conversation coming up later this hour. And we are back with Harold Vanderland of HSBC Global Research. And, Harold, we were just teasing to this block in the last conversation about, of course, the policy support that could come out of countries like China. But what else are you watching in terms of ex-China, ex-US in the region here? Because you actually like Korea over Taiwan. I haven't heard that for a while. What's going on there? What's the dynamic that you're seeing?
Yeah, so we've preferred Korea over Taiwan as an equity market since the beginning of this year. And actually the reason is very simple. There's good growth coming through in Taiwan. To a large extent, that's just driven by one company, which is all about AI and chip making and foundry. In Korea, the growth story is much more diverse, actually. But the real reason why we actually like Korea over Taiwan is that Taiwan is an incredibly crowded space. On average, the average Asian fund has about 10% of its portfolio in the largest stock in Taiwan, TSMC. So that's a lot of exposure, and we felt that it's just, if this volatility happens, well, of course, that wasn't what we were forecasting at the beginning of this year, but we felt that it's such a crowded space. If something happens, a lot of people will be exiting the door at the same time. So we've preferred Korea for that particular reason. It's cheaper and it's under-owned.
Yeah. The under-owned, undervalued, and undervalued is really the story, chronic story for South Korean markets. What could change that? I mean, is there a line or the duration that you're watching for South Korean stock markets? Because not many people are really seeing the fundamentals staying strong in 2025.
No, we felt that actually, and this, there's a lot going on, of course, in markets, but we felt in the beginning part of the year that memory prices, on which Korea is much more exposed to, were starting to look a little bit better. So that is providing some support for some of the key players in that particular market, key constituents in the Korean markets are Hynix and Samsung, for example. So that's the first thing. You are right, Korea is cheap, much cheaper than, for example, Taiwan, and has always been so. But if we look at the level of cheapness, if you want to put it like that, we are really, really cheap at the moment in Korea. So that's one thing. Can that change? That can change. We've seen this, for example, in Japan. If corporate are starting to pay more dividends, take some of the cross-holdings out, do more share buybacks, that can lift valuations. And we see early signs that this is taking place in Korea. So that's supportive to valuations as well.
Harold, thank you. Harold Vanderland of HSBC Global Research. And the China Connection will start at the top of the next hour. Of course, Emily Tan is here to give us a sneak peek on what's coming up this morning.
That's right, Sherry, and a very big day that is going to be unfolding here, and we are tracking the market action. We're seeing rebounds across, of course, Taiwan. We're going to be looking to that in Hong Kong as well. Beijing's reciprocal 84% tariff goes into effect today, and I'm going to be talking to the likes of Stephen Roach about China. He was just there for the CDF as well as the Boao forums, discussing the Trump U-turn and also the most famous influential economist in China, Li Daokui, from former PBOC advisor, all on the show, The China Connection.
Thank you very much, Emily. And we are going for a quick break. We'll be right back with Hong Kong and China Market Open.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Social media is the great tool for promoting yourself. So we have to look about, the different range of people using social media. For older people, we have to go to Facebook. For younger people, we are really focusing on influencers. And every single event that we have in Andalusia, many concerts, we are trying to take an influencer.
Well, I think social media is allowing us destinations, and especially Spain, to showcase who we really are and what do we do. And social media content creators, our collaborators, they are all about what is Spain about and how can you interact with the people of Spain, because we are truly convinced that we live happy lives and we want people to share our happy moments in Spain with us.
The Power Plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers. Weekdays, CNBC.
Are you drowning in debt? Stressed over savings? CNBC Make It is here to help. Start your journey to financial wellness today with our new online course. Our experts will teach you about money psychology, saving for retirement, and increasing your investing IQ.
Achieving financial wellness is freeing, it's empowering.
Your healthy relationship with money starts here. Register right now at cnbcmakeit.com/financial wellness.
Every new vehicle we put out, we're improving fuel economy and emissions.
We need a balanced and a fair energy transition for everyone.
The total value chain of battery will be very important.
Improve our operational efficiencies and reduce the consumption of natural resources.
Environmental sustainability is a must, and energy security is another pillar.
Renewable energy is cheaper than electricity made from fossil energy in 90% of the world already today.
Fostering sustainability on CNBC.
To me, ambition is drive. It's the fire in your belly. I didn't go to college right out of high school, and I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. No one's going to give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
You are watching Squawk Box Asia on this Thursday. Markets in Hong Kong and China just coming online. Lots of celebration going on in the region. And of course, we follow up on that party that we had, the big rally on Wall Street overnight. And we've got that celebrations actually spilling over to this part of the world as well. The Hang Seng Index popping by close to 3% at the moment. And checking in on the early movers, Hang Seng Index, the heavyweights on the Hang Seng Index. Let's take a look at that because we've got the green across the board. HSBC leading the gains at the moment on the board there, higher by 4.8%. And Chinese markets and the yuan very much in focus, the currency of the hour and of the week for sure. So let's take a look at that because we did see the yuan midpoint fixing coming in at the weakest level since September 11th of 2023 here. And we've got, stocks also surging at the moment. And we are actually waiting for the inflation figures out of China this morning. But as we are waiting for those numbers to cross, lots of questions that we need to still be asking. We're just asking different questions for China as well because President Trump did up the tariff level on China to 125% just overnight. I guess the number one question is, can China handle that kind of level of tariffs? And will Beijing, what will it do to respond to all this? And how does that impact others? And is this something very technical in terms of the rally that we see in the markets, or at least when it comes to the stock markets? Now, let's talk about the numbers, the inflation numbers out of China this morning for the month of March. CPI, let's kick off with that, down 0.1% from a year ago when the Reuters poll was no change. So just still a little bit underwhelming, the estimates here. PPI is something that we also care about. March PPI down 2.5% on the year, and this actually is under the estimates that we saw in Reuters poll, which was a minus of 2.3%. So certainly looks like it is facing some challenges in terms of inflating the country's prices here. So the question going into this particular data point, Marty, was that can China somehow change this deflationary dynamic? That doesn't seem to be the case, telling from of course, the data points that we got here. And it's really the similar dynamic month on month. March CPI down 0.4% on the month as well.
Yes, I think it's interesting, Sherry, that in terms of retail as well as pipeline inflation, factory gate or wholesale inflation, prices missed to the downside. So deflation in China continues, and we're looking at the currency there. This is offshore CNH, 36.65, and the fix that you just talked about, which happened about 18 minutes ago, 9:15, was again softer by baby steps. So no big one-off devaluation, at least just yet. I would think, though, that potentially the risk could be rising now the tariffs on China, U.S. tariffs on China, are at 125%. But as they continue to let the currency weaken, though, that is not going to help their deflation situation. So something to watch there. So, Sherry, something that we're talking about all morning long, President Trump's U-turn on tariffs. So we've seen markets bounce back and steady, not just stocks but bonds as well. But that pause is also going to buy time for countries to negotiate with the U.S. We've had Japan, South Korea, Vietnam all doing that right now. Of Asia's big economies, though, India is probably the most proactive on that front, and not just with the U.S. as well. Inside India's anchor, Sri Jagaraj, has been following what's been happening. Good morning, sir.
Good morning, Martin. Great to be on the programme on the other side this time round. But India is a really unique case. So a friend, quote unquote, of President Trump was still hit with 26% tariffs. But when you look at this broadening, this widening tariff differential, India seems to be spared from the worst of it, and the tariff differential works in its favour. Yes, but at the same time, India is not taking anything for granted at all. I wanted to show you the price action in the car makers, in the IT services, in pharma, and remember, at a sector level, Trump yesterday reiterated that there will be major tariffs on the pharmaceutical industry globally. So this was a big problem. So yesterday, that's why we saw those sectors hit the hardest. Hence, India wants to pull out all the stops to tariff-proof the export sector as much as it can. So US-India bilateral trade agreement is a big part of that, and it would really re-energise and take the entire Modi Make in India campaign further. In terms of what Commerce Minister Piyush Goyal wants to achieve, he wants to fast-track a BTA to negate, essentially, the 26% tariffs. What does this mean? A big part of this proposal would be centred around the production-linked incentives. So US imports, in theory, would qualify for duty-free. There would be zero tariffs, but they would need to be directed into the PLI sector. So we're talking a zero tariff setup. In terms of the numbers here, government is working with industry, seeking their input and buy-in. And I wonder if we have that soundbite from Sanjay Nair from ASOCHAM that we spoke to yesterday, with his view on his membership and how they feel about a BTA. This is what Sanjay Nair had to say.
Look, I think it's very critical, and this may be a call to action. This government was already in action mode, like I said, in terms of closing out FTAs, but now the BTA with US becomes, I think, extremely critical. 18% of our merchandise exports out of the US. It's not a small number. It'll be foolish to say we will not be impacted. I think we will be impacted. So the BTA is one way to clearly get some uncertainty out of the way. What is clear is that tariffs will have to come down, that we impose both non-trade and trade, which again means that the companies will have to become a lot more competitive, and there is no shielding away from the real competition that they're going to face. So that's number one. Number two, I think they will rejig their supply chains, which is good. The China plus one factor plays in our favor. You're seeing what Apple exports are. I just saw it on your screen.
So very clearly there, at the highest level, government is working with industry and the exporters to seek their input, to consult them and to seek their buy-in as well. So India has a working time frame, Martin and Sherry, of autumn 2025 for completion of this BTA. By the numbers, $500 billion by the year 2030 is India's bilateral trade target, more than doubling the current figures. So this is ambitious. Can I also say that India has been, and this predates the narrative on tariffs that has become so volatile right now for the markets and the macro. And India has been very actively engaged in discussions with the Europeans, with the British.
UK as well,
exactly. In fact, Finance Minister Nirmala Sitharaman is currently in the UK on a trade mission, and Chancellor Reeves and Minister Sitharaman seem to be quite confident of concluding a trade and investment deal soon. And nothing seems to be off the table, even a conversation with India. And there's even a Chindia nexus that seems to be building at the moment. And this was, at one point, unmanageable. And it's fascinating to hear now that...
Chindia as in China, India.
China, India.
Right.
Yes,
Okay.
that's right.
Yeah.
And there's even a conversation about, potentially, should India be consider joining RCEP? Should it consider joining CPTPP? Should it really expand and be part of this expansion of regional trade alliances?
So let me ask you this question, right? As India finds its way ex-U.S., right, as the rest of the world finds its way ex-U.S. and they decide to cooperate and to trade more with each other under a lot of existing trade arrangements, right? What is the risk, though, that they could end up being on the receiving end of China's excess capacity, right?
Exactly.
We're talking about dumping and flooding of Chinese goods into, Southeast Asia is worried. Is India?
Exactly. And it's not just China. It's Southeast Asian goods finding their home and being dumped onto the Indian market. In fact, a lot of economists that I've been speaking to are distantly concerned about the second-round impacts and second-round effects. Fitch has said this. While the direct impact of the reciprocal tariffs in India may be limited, the secondary effect of excess supply entering the Indian market stemming from regional imbalances caused by US reciprocal tariffs could affect sectors such as chemicals, textiles, steel, and industrial machinery. So that really highlights the need to expand the partnerships. And this is all part of the great reorientation and diversification that we are seeing. And quite frankly, India has been on this journey since before the tariff headlines, but it's taken on a greater sense of urgency now.
All right, so you'll be following all of this, I'm sure, coming up at a little later this morning on Inside India,
Absolutely.
your show. What else do you have coming up? Any big guests?
Yeah, this is post RBI, by the way, as well, and keeping some powder dry. They didn't go for 50, they went for a 25 basis point rate cut, so they're not taking anything for granted, but quite clearly keeping the powder dry. We got Mathieu Botot from Portfolio Manager Fiera Capital, and we're going to stress test the investment case for India since it seems to have escaped the hammer blow, and yet there are concerns about the consumption story. We'll talk about the possible supply chain dislocations and how the apparel manufacturers are coping with Joe Distel from Bratex. And we will get a pulse check, as I said, on the Indian consumer with Harsh Mariwala. This is going to be a very interesting interview with me because he's the founder of Marico, which is the 8th largest FMCG company in India, presence in 25 countries, so very internationally diversified, but a big bellwether of India's consumer and the Indian economy. And it's really the local domestic businesses, the consumption story, the banks that have been doing reasonably well throughout this bout of volatility. And as I said, Sherry and Martin, it's really export-facing sectors of IT services, pharma, and the car makers, Tata Motor, Jaguar Land Rover, of course, being their luxury brand.
Yeah.
That have been at the pointy end of things.
Okay, Sri Jagaraja, Inside India Anchor. Show starts at 11 sharp Hong Kong, Singapore time, right here on CNBC. Sherry?
Yeah, and thank you very much, Sri, for that. And one of the key reasons that U.S. President Donald Trump imposed stiff tariffs on its trading partners is to bring manufacturing back to the United States, but reshoring to America doesn't make sense For low-value, labor-intensive industries like garment making, Hong Kong-listed Lever Style, a global clothing and apparel manufacturer, could be affected by Trump's levies as the United States contributes a big chunk of its revenue, while Lever Style's manufacturing bases are all in Asia, namely in China, Vietnam, Cambodia, India, Indonesia, and Bangladesh. So let's do a deep dive with Stanley Sito, Executive Chairman of Lever Style, joining us right now in Hong Kong. Good to see you. Good to have you. So talk to us about the conversations that you've had over the last 5 days or so, including this weekend, in terms of communications that you had to have with your customers, and also maybe some decisions that you had to make.
Well, conversations have been changing every day. Yes. So, they have been taking place since, I guess, April 2nd. But things are changing every day. Just last night, we found out that Donald Trump is putting on a 90-day reprieve on all imports except for Chinese imports, right? So, and God knows what's going to happen tomorrow. But so far, a lot of the conversations have been, wow, this is just, the world's coming to an end, but we don't know what to do yet because things are changing. So a lot of our clients are sort of asking us to just, let's just continue, hold, and let's see what happens, how things settle in a few weeks' time.
Okay, so sit tight for now, but this is a conversation that's not really going to go away. This competition between the U.S. and China and some kind of, pressure on each other. And for you to go into, China would make sense given your base, but some of the Southeast Asian bases that you have for production, you are trying to be nimble because of the previous episode of a tariff war. Do you think about any other places for potential candidate for your production capacity? Absolutely. We used to think that it's okay to be Pan-Asia, but within the last week, we're telling ourselves that's not enough, and we're looking at, we'll be looking at Turkey, let's say European countries like Portugal, Morocco, North Asia. Europe is Turkey is a major garment producing center, and also Portugal / Morocco. That pairing is also very strong at certain products, and they've served the European market, with lower duties and faster lead times. So those have always sort of appealed to us, but then in the past we've been busy expanding in Asia, so that would have been our next step anyways. But I think right now the situation called for us just moving quicker. And actually this morning I was talking to someone about, hey, how do we explore Mexico? What about, talk to us about pre-tariff episode, this episode of tariff war, because in your last earnings call, in fact, you were talking about what some of the customers of yours are going through in terms of liquidity problem, not being able to make certain payments. What is going on in terms of demand, apart from this tariff war? Well, demand has been softening with, I guess when Donald Trump won re-election, there was sort of euphoria in the financial markets, and people felt more upbeat. But as policies, keep on changing, and then with the Wall Street, the way the indexes, just crashing the way they have been, even the Main Street, people are just sort of holding off, and we're seeing our customers being a little bit softer on their fall sort of order placement, a fall season, that is. And so I think even our customers are becoming more cautious. So I would say your customers' revenue, their exposure are already showing the demand is softening, and these tariffs could actually put upward pressure on inflation. Yes, absolutely. Tariff, at the end of the day, the supply chain cannot absorb the cost of the tariffs. And so the brands and retailers will have to raise retail prices, and ultimately it's the consumers that's paying for it. So if you let this play out, brands are actually, some of our customers are already asking us, make those garments, but hey, we need to change the price tickets, right? They're already saying they're preparing to raise prices. Yeah. And whenever that happens, consumer demand will go down, right? There's a sticker shock. I used to buy this sweater for $100. Why, and then this year, why am I asked to pay $150? So initially, people were going to, let's just hold off. And so we can see sort of a demand coming down, and brands, they have their overheads to pay for, and we're seeing more financial strain going forward if the tariffs hold up.
Stanley Martin here. Let me quickly jump in with a question. Obviously, because of what you do, you've got very high visibility into U.S. supply chains through your clients, right? Now, I was just talking to my colleague Sri about this a couple of minutes ago. There is a risk and a fear that as the rest of the world, including Asia, right, get together, cooperate, and trade among themselves more, one of the risks or consequences is that China could end up dumping and flooding a lot of these markets with its excess capacity, including stuff like, I would think, textiles and clothing, which is the business you're mainly in. When you get asked that kind of question, how do you respond? What do you think? What is that risk?
Well, at least, I'm not familiar with other industries, but in our industry, China is a relatively high-cost producer. So, is it going to dump into the rest of, be able to dump into the rest of the world? I'm not so sure. Right now, actually, looking at another industry, the EV industry, the U.S. is already slapping 100% tariffs on Chinese cars. So Chinese car makers are selling elsewhere, but China itself is a huge domestic market. So, a lot of, I guess I can imagine most of Chinese car production serves the domestic market. And actually, that's the same for apparel. So China production is increasingly becoming China for China. So it's for Chinese brands or foreign brands that sell in China.
I don't know if you saw the meme going around on social media, all these American workers trying to make clothing there. But have you thought of, at any point, bringing more production to the United States?
Well, not in a very meaningful way. It's a non-starter. It's got some niche production, for example, making denim in LA. So there are some small workshops, but garment is a very labor-intensive industry, and there are just not that many bodies in the U.S. And especially, it's a skilled labor requirement. So it takes months and years to train up these people. So you just can't do a snap of the finger and say, okay, well, we move production back to the U.S. And if you think about labor costs in the U.S., even with 100% tariffs, it will be cheaper to import from elsewhere in most cases.
I thought one line stood out to me from your notes that you sent us, that you are actually hoping for a repeat of COVID times. You're probably the only one who said that. But why is that? Because of the acquisitions that you were able to make during those times. Are you thinking about maybe this is the opportunity?
Yeah, during basically 1 year of COVID, our company made 5 acquisitions, and that allowed us to expand into a lot more markets, into a lot more products, and that powered our post-COVID rebound. And and we were able to do that during COVID because valuations became a lot more sort of reasonable. Right. And in the past 3 years, we have our acquisition we just haven't done as much. And we're thinking, if the economy turns south again, and brands order less, and then that puts pressure up the supply chain, then we'll be in position to acquire and to roll up and to consolidate. And we just announced our results, I guess, a month and a half ago, and we have 2 years worth of earnings of net cash sitting on our balance sheet, waiting to be deployed. And hopefully we'll find good opportunities this time. How
are you able to do that, though? Because does it come from mainly the fact that you don't really own these factories? Is that the model that you think that gives you that edge and also that cash pile?
Well, we have an asset-light business model that allows us to be much more nimble, and then we've also been making reasonable profitability, and that just builds up the cash in the bank. And we feel very fortunate that with a business model that's sort of like an Uber that's competing against a fleet of cars, and we've been able to gain market share and achieve reasonable profitability, and that allows us to grow faster.
Okay, Stanley, thank you very much for joining us in this volatile times. Thank you very much for your insights this morning. That was Stanley Zito, Executive Chairman of Lever Style. And we're coming into the final stretch of Squawk Box Asia. Don't go away. We'll be right back.
Today's Most Active Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's most active stocks update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Channel Japan. Get the latest stories from Japan as they happen on the ground. This time we're at the Japan Traditional Crafts Revitalization Contest being held in central Tokyo. We also have a new episode of a festival, a celebration, a merry meal. And feature a festival in Nihonmatsu City, Fukushima Prefecture, where floats carrying massive dolls weighing a ton engage in fierce clashes. Don't miss it.
The ultimate pre-market morning news show. Squawk Box, CNBC.
Today is National Beer Day. Everyone with a 401k has been celebrating since last Wednesday.
Jimmy has the voices, Adam Levine, Bella Ramsey with a rap roundup.
That's a season one recap of The Last of Us.
And from the White Lotus, Sam Neville. This weekend.
Welcome back. Thursday morning here on Squawk Box Asia, and we are continuing to track the follow-through out here in Asia after just a stunning rally on Wall Street overnight. Remember, the Nasdaq up 12%. That is the biggest one-day gain we've seen in years, if not history. So the follow-through, it is positive, and it is looking sharp out here. But big markets like Tokyo up more than 8%. Korean market is up 5%. And I want to show you it's not just stocks finding their footing as well after very heavy selling in the last 3-4 sessions, but also the bond market. Remember, we've had this strange coincidence and correlation of asset classes with stocks falling and being sold, bonds falling and being sold, dollar being fall and being sold as well. But even bonds are steady. Take a look. You've got the 10 for 28.32, short end twos at 387. And Sherry, you know, we haven't had a chance. In fact, I think we did, but I want to replay that soundbite from President Trump on the bond market. This is after he made that U-turn on tariffs. Let's take a listen to this.
The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy. I think everything had, well, the big move wasn't what I did today. The big move was what I did on Liberation Day.
So, Sherry, I'm not sure it's quite beautiful is quite the right word, but it's certainly less ugly than it was just a day ago, because, I mean, 428 on the 10-year yield.
Yeah.
I'm not sure. What do you think? And you've been talking about, the sell U.S. trade, right?
Yeah, exactly. I mean, the bonds were selling off, the dollar was selling off, and I feel like for the first 2 days of this week, we were asking wrong questions. It wasn't about the U.S. and China. Maybe it was about, I don't know, Trump versus the bond market, right? And I think he may not say it, his administration may not say it, but I think a lot of market participants, the people that on my chats too, Trump blinked, and the bond market definitely sent that message. But I do want to say, be careful with this rally. Is it a pause? Not exactly. The 10% is staying on. So I think that's something that we need to be mindful of. And let's see if the rally continues, or at least stabilize from this level.
Futures
and that brings
right
us to the end. Yeah, and turning negative on the Nasdaq as well. And that brings us to the end of Squawk Box Asia. I'm Sherry Kang in Hong Kong.
And I'm Martin Sung in Singapore. Stay tuned. The China Connection is coming up next. See you tomorrow.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Power Lunch, CNBC.
You're French, the son of two physicians, grew up in a family where you're focused on medicine and life sciences. How would you describe your leadership and your management style?
I'm very collaborative. I don't like consensus, which was something we changed
you don't
in
like
the company.
Consensus?
No, because I think that consensus is slow first, but also sometimes impossible to reach when you have a tough decision to make. So often everybody agrees, but if there is no consensus, it's not a reason for not making a decision. So very collaborative. I try to have a lot of proximity with people. I am very approachable. I want to be very inclusive. I empower a lot the Takeda executive team. So again, I think creating a culture of performance, but respect and inclusion and collaborative.
We're moving from the autopilot era of AI to co-pilot era of AI.
We are just at the dawn of the robotics age.
The more experience you give it, the more capability this AI model can achieve.
Hopefully improves productivity, and it doesn't displace more jobs than it creates.
How to maintain our humanity if we live more and more digital lives.
The new era of tech. On CNBC.
There's a difference between ambition and greed. Greed is wanting more. Ambition is wanting better, and not just better for yourself, for your family, for your community, for your country. There's no reason to want CNBC if you're not ambitious, right? If you don't want better insights, better returns. And that's not just financial, though money is a part of it. We're talking about value.
It's 10 a.m. in Hong Kong and China. Global markets in the green. Following the Wall Street turnaround overnight, here are your headlines this morning. Markets are rallying and bond yields paring back in a historic session on Wall Street after President Trump's stunning reversal to lower and pause tariffs for dozens of countries, except China.
The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy.
But Trump keeping up his massive gamble with China, hiking tariffs to 125%, but suggesting that's the peak after Beijing retaliated with 84% tariffs in a dramatic escalation between the world's two largest economies. China's Commerce Minister keeps the door open for negotiations to resolve their differences, but maintains it will fight to the end if the U.S. insists on having its way. A very good morning to you. Welcome to the China Connection. I'm Emily Tan in Hong Kong. Taking a quick check on the markets across Asia this morning, and it is a huge rally that is unfolding, of course, with all the developments just in the last couple of hours. We are tracking sizable monster gains here for the Nikkei 225, up 8.3%. Another big winner is the TAIEX, pushing gains close to 10% as we have TSMC, the most heavily weighted in that market, pushing limit gains of 10%. Also on the up and up is KOSPI, better for 5.25%. In Singapore, the Straits Times Index, better for almost 6%. 6%. We have the Philippines as well as the Jakarta Composite also better on the session. We are keeping an eye on what's happening in U.S. futures after that dramatic session overnight. And it's looking like this. We are still a number of hours out, but it's looking a little bit mixed here, and maybe some profit taking that could be setting in. The Dow set to open just with a slight positive bias. The NASDAQ tipped lower by 0.75%. We're coming off that historic session on Wall Street with the Dow soaring nearly 3,000 points, its biggest point gain ever. The S&P 500 had its best day since 2008, and the NASDAQ up a massive 12% for its best day since 2001. Still, we should note that the U.S. markets are still in negative territory so far this year, and treasuries, which were a major pressure point, also moderating. The very long end of the curve backing off near 5%. We've got the 30-year currently at 4.6912%. Firm demand at a closely watched 10-year bond auction also helped to provide some breathing room. We're looking at the 10-year at 4.2812. And that turnaround happened midday in the U.S. when Trump said he would temporarily reverse tariffs because he noted people were getting a little afraid of tariffs. And after Jamie Dimon's recession warning in an interview on Fox News, the moves were nothing short of a stunning, dramatic 24 hours. Now, this is where things stand as of now. Trump has hit pause on tariffs for dozens of countries for 90 days, temporarily lowering them, keeping just 10% base for all. But he ramped up the levies on China to 125% hours after Beijing retaliated to Trump's 104% tariff with an 84% rate on the U.S. Trump also saying he thinks 125% is the peak, and he doesn't think it will need to go higher than that, as he still holds out for a deal with China.
China wants to make a deal. They just don't know how quite to go about it. You know, it's one of those things they don't know how quite. They're proud people. And President Xi's a proud man. I know him very well. And they don't know quite how to go about it, but they'll figure it out. They're in the process of figuring it out, but they want to make a deal.
And let's take a quick check on how the Greater China markets are faring. Of course, Hong Kong and China in action for the last 30 minutes, and a strong session that is playing out, most notable in Taiwan there. The Hang Seng Index better for 4.5%. Shenzhen firmer on the session by 3.6%, and the Shanghai Composite at 3,223. Amongst the things that we are watching is the national team. Of course, with all the support that we're seeing coming through from Asia, the national team can potentially be on a standby today. We are tracking what's happening in the currencies as well as CNY after the PBOC set the midpoint today at 7.2092. We are looking at the CNY 7.3485, strengthening just a touch. The offshore in Hong Kong at 7.3641. This comes as we had some inflation readings earlier in the day. 30 minutes ago, CPI for the month down 0.1%. And PPI contracting by 2.5%. So we are watching this risk of deflation in the Chinese market. China must go and boost its domestic demand. Sluggish demand in the country, of course, coupled together with overcapacity, leading to the price wars that we are seeing across many of the sectors. So if that coupled together with, of course, less demand from the United States, that spells trouble. So we really need to see a boost in consumption in the Chinese markets. Let's take a look at some of the exporters traded in Hong Kong. We should be seeing a big comeback today. Names like Lenovo that we've been tracking, Tektronic Industries, Yuyun, all of these are huge exporters, and we're looking at Lenovo shares. Remember on Monday when we were speaking to the CFO, Winston Chang, and we saw the stock drop 15% in the morning, closing the day down almost 23%. So we are making back most of that as we speak. Yuyun, which makes the sneakers for the likes of Adidas and Nike, shares better for 9%. We're also tracking some of the logistics plays as now China Plus One, this strategy has come back to life, if you will. Vietnam getting another chance here at being a production and manufacturing site. So some of the logistics plays in focus today. JD Logistics shares better for 3%. Let's get to our first guest. And Stephen Roach, a senior fellow, Yale Law School at Yale University, joins us now live from Connecticut. Thank you very much for staying up late your side, Stephen, on this very big day on the markets as we're watching all of the latest moves to come through. I want to get your take first on, what happened in the last couple of hours. Trump, of course, pushing back the reciprocal tariffs. It was his, what did he call it, Liberation Day, and now he's backed off that, except he's kept the pressure and the 125% on China. What is your take?
Well, Emily, it's good to be back with you. And I think the extraordinary surge in the markets on Wednesday afternoon in the U.S. just indicated how close the markets had come to getting caught in what I would call a death spiral. Not just the equity market, but really the interplay between the bond market and the currency market. The U.S. has a large current account deficit, needs a lot of foreign financing to keep its economy growing. And, if foreigners get spooked by funding the current account deficit, they will demand concessions in terms of providing the financing, and that means higher yields on treasuries and a weaker currency. And we were beginning to see the early manifestations of that type of a phenomena playing out. And so Trump's hands were really forced by this confluence of market forces that were bearing down on him. He certainly did flinch. And as soon as he flinched, the markets relaxed and started to make up for a lot of the carnage in recent days.
Now, we've heard that 125% could be the top. Where do you see Trump's off-ramp here? What could be his next move? Of course, given that we haven't really heard whether or not there will be further retaliation coming through from China, the Commerce Department has come out this morning to say that they will continue to fight to the end.
Well, Trump said he hoped that 125% would be the top, but I've learned, and most of us in the U.S. have learned, that he can change his mind at a moment's notice. So I would not take that as a sure thing in any way whatsoever, especially if China follows its pattern of recent days and matches the latest sort of penalty tariff by the U.S. with another move of its own. And, I think all bets would be off from the standpoint of the U.S. response were that to happen. In terms of China's, adamant insistence that it will fight to the end, this is not just a slogan. I believe it's deeply anchored in the political commitment that China has made in the form of what Xi Jinping has called the Chinese dream, emphasizing prosperity and rejuvenation, and having the determination to fight bullying and subjugation by any foreign force who stands in its way. And what Trump's actions have done is certainly run very much against the grain of the Chinese dream, and this fight to the end is a very visible manifestation of what China, how China is responding to this external pressure.
Now, one way that China can respond is through financial markets. Let's talk about that in a little bit. I first want to discuss what we're seeing in terms of the reaching out to the European Union, where they have said now that they're willing to engage in talks when it comes to electric vehicles, about overcapacity there. Also, we have President Xi Jinping. He's going to be meeting the Spanish Prime Minister tomorrow. He's headed to Hanoi next week, also a trip to Cambodia as well as Malaysia. In terms of rebuilding or reinforcing relationships, What do you expect?
Well, that's a very important point, and one that you can lose sight of with all this fixation and frenzy on tariffs. What President Trump has also done is he's really threatened the long-standing alliance between the United States and Europe. And Europe is, very distressed and angry, understandably so, with the U.S. administration for doing that. And they would be, as a result, far more inclined to strengthen their economic relationship with China as a result. That's a very different world than the one that we have become accustomed to, where our greatest ally in the United States turns away and goes to what has now become America's major adversary in terms of trade relations.
Whether we liken this to a game of poker or talking about it like chess, a couple of pieces here that we're looking at are the TikTok deal and CK Hutchison. More about TikTok. Do you think that Beijing will allow for a sale to a non-Chinese owner? Do you think it's going to just let it go as part of this trade back and forth?
Well, first of all, I would say if I had to characterize a game, it's more like poker rather than chess. I think chess gives Trump too much credit for his strategic acumen. And, sticking with the poker metaphor, what happened today in the U.S. is the president just laid his cards on the table. He showed that he will flinch and flinch once again as markets put pressure on him. And I think that China is, at this point, understandably quite defensive with respect to the U.S. Escalation of tariffs and the characterization that's come from the Trump administration that this is all China's fault, that it dared to retaliate in response to an action that was taken unilaterally by the American president, as if no nation has the right to defend itself from economic warfare. And I think under that, or in that context, that China's unlikely to just all of a sudden cut a deal on TikTok. I think China would be looking for a more stable and constructive relationship with the United States before it were to do that.
How else could we see retaliation, whether it's through financial markets? Because in China, the financial system is very different. It is state-owned. There are capital controls. The government, of course, it's state-dominated when it comes to the banks. They're all state-owned enterprises. There is an allowance for state intervention. How do you see China taking it from this angle? Could they go through via treasuries? Could they go through via depreciating the yuan?
Well, first of all, I just want to stress that China is certainly dependent on the United States, and so these tariffs do represent a real threat to its export-led growth dynamic. Even though the U.S. share has come down, the U.S. is still China's largest foreign trading partner. But the U.S. depends a lot on China as well. China is still America's third largest export market behind Canada and Mexico. And China's still the second largest foreign holder of U.S. treasuries. So in terms of further actions that China can take, it can limit U.S. export growth into China further. It can, as you said earlier, move to take the renminbi lower, as it appears to be doing right now, and as it did during the first round of tariff hikes in 2018 and 19. Or, if push comes to shove, and the U.S. just continues to escalate the pressure on China, there is always the nuclear option with the China's Treasury holdings. Doesn't necessarily mean, a wholesale fire sale of Chinese Treasury holdings, but it certainly could start out with China being notably absent at upcoming Treasury auctions, and that in and of itself would be a major signal of more pressure to come.
So as we wait and watch these two largest economies in the world and their leaders continue to play poker, how do you think it's going to be playing out in the markets?
Well, I mean, the markets sprung back dramatically Wednesday afternoon in the United States, again, reflecting the fact that they were peering into the abyss just a few hours earlier. But there's, I think, pretty widespread recognition that we're still in a period of heightened uncertainty. This is a 90-day pause. And again, with Trump, you never want to take his descriptions of scenarios as carved in stone. I mean, he says it's 90 days today. Tomorrow he could say he changed his mind and shortened it or lengthened it. He could intensify pressures on China. He could relax them. No one knows what he's going to do next, but we do know that the spring back today does not mitigate the uncertainty that's likely to be evident over this 90-day pause period, if that's what it ends up being. And the uncertainty is not just a problem for investors, but it's also a problem for corporate decision makers who hate uncertainty when they have to make major fixed asset decisions with respect to capital spending or hiring. So it's really going to have a deleterious impact on real economic activity, even though the worst seems to be over for financial markets for the time being.
Stephen, always useful and very insightful for you to come and talk to us today. Thank you very much for joining us. And we are going to be watching out for China's next move in this poker game. Stephen Roach from Yale University, thank you very much. Beijing has issued a warning to its citizens about traveling to the United States. CNBC's Evelyn Cheng has the story.
Thanks, Emily. As the Chinese Ministry of Travel and Culture has issued a warning about Chinese tourists traveling to the United States, this also comes as China's Ministry of Education has also issued a warning to its students that are studying in the U.S. This comes after there's been more reports about certain states or certain schools that have canceled the visas for some Chinese students in the U.S. We don't know exactly the extent of this yet, but certainly just adds to how the rhetoric in both China and the U.S. have been escalating over the last week, just to show how there's this posturing of being tougher and tougher on both sides. And as I explore in this week's edition of the China Connection newsletter, there is more and more less clarity on any kind of deal between the U.S. and China. And analysts are getting more and more worried about how this conflict could spread beyond just tariffs into more restrictions on technology and maybe even into other realms. But on the other side, there's also expectation that maybe this is both posturing. What we've heard from China so far, too, is that they are really going to double down on their efforts to support the economy. They're saying quite clearly how they have the tools, how they're preparing to support the economy. And we've just had reports from Fujian province, which has many exporting companies, and how this province is exploring ways to support these exporters to explore ways to tap the Chinese domestic economy. Although, as we've just seen from the CPI report, that the domestic demand is still quite weak. But as the posturing continues, there is less and less sign of a particular deal in sight, but we'll have to see whether this just creates a higher bar for both sides to claim some success on as they roll back. Back to you.
Evelyn, as we watch the latest to come through between the U.S. and China and whether or not there will be any talks between the two countries, we do know that President Xi is expected to be meeting with the Spanish Prime Minister in Beijing tomorrow, and he heads over to Hanoi next Monday. Beijing now is looking for other trading partners.
Definitely, and the Chinese Commerce Minister is also expressing how China wants to work more with ASEAN. And really, we look back since the first round of the trade war between U.S. and China, China has really increased its trade with Southeast Asian countries, with even the European Union, to surpass that of the U.S. So while the U.S. still accounts for a large part of China's exports, it's not necessarily as big as it was a couple years ago. And I just was speaking with an economist, and he was expressing how because Trump has rolled back some of the tariffs on other countries, even though he's increased them on China, that could signal how Chinese exporters that have been expanding to Southeast Asia and to other countries, that they could still reach U.S. markets with a lower tariff rate.
Evelyn, and thank you very much. For more on Evelyn's story and deeper dives into the Greater China region, sign up for our China Connection newsletter using the QR code currently on your screen. The China Connection will be back right after this.
The Philippines has been stuck in an infrastructure deficit for a number of decades. Should it not be attended to, it will continue to be our really number one roadblock to sustaining our economic growth. We focus our attention on power, gas, waste management, and water. For each one of those sectors, we try to address a fundamental need. When water is reliable, we have dependable energy, we treat our waste the way it should be treated. Certainly, we create an ecosystem that's more conducive to foreign direct investments and economic growth. Sustainability and growth for us are one. We get things done. We are relentless. We deliver that critical infrastructure. The challenges are significant, but we've created a team that's extremely talented, absolutely equipped to execute.
Crucial market coverage, actionable insights, can't miss reporting that'll impact the tape and your money now. Be here when the opening bell rings. Squawk on the street. CNBC.
She's wiping her juice hands in my pants. My name's Josh Gerasitano.
My name is V Farm.
This is what we do during our downtime.
Oh. Wow. The flavor here really, really good.
I drizzle the Nook Mam all over it. She got the watermelon juice.
You don't need to say people can see watermelon.
I got the Cafe Moi. Yeah, it's just a bit salty. Hold on, we're going to get changed, okay? It reduces fatigue, it's good for your skin, and it helps the immune system. I normally have like 5 or 6. I just crack it into a plate and then have it all at once. We always come here. It's probably our favourite place. Wow, this is really good.
Asian markets are sharply higher this morning. The Nikkei and the TAIEX leading the gains. We have heard from the Taiwan financial regulator that they're going to be announcing whether to extend a temporary short-selling curb for stocks this Saturday. So it runs all week, where the average daily turnover on stocks in terms of shorting reduced to 3% from an earlier 30%. Big gains coming through from the TAIEX, pushing gains of more than 9% on the back of TSMC. It's most heavily weighted stock on the benchmark there, limit up 10%. Lin is watching one of the big movers in the Japanese markets this morning, and 7-Eleven operator 7NI. Lin, tell us more.
Yeah, hey, they did report earnings here, and even though their quarterly operating profit actually declined for a fourth straight quarter, minus 15%, we are seeing a big move to the upside for the stock and outperforming the retail sector as well. And I think that's really on the buyback news, the fact that there is a 600 billion yen buyback by next February here. In terms of the sales outlook, though, the focus continues to be, and we heard again from the executives, the impact that inflation is having, particularly on the US market, which accounts for about 70% of its sales. It doesn't have a big China exposure, particularly because it is now spinning off those supermarkets to Bain Capital as well. Domestically in China as well, having an impact as well, as we continue to watch as well the tariff impact, with management saying that they are watching that because of the uncertainty here.
Lin, thank you very much. We're taking a quick break on the China Connection. We'll get you more market action after this.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money? Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC. We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought that was the end of it.
To the C-suite.
I started on the factory floor, and here I am 35 years later.
The economist and author Dambisa Moyo.
A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
You want people to trust their money.
This is the market that we're operating in. They need to drive their plans forward.
We need to pursue new business opportunity.
You're always better off having a fortress balance sheet.
Prudent fiscal policy can contain debt.
You're going to take less risk to get to your target now more than ever before.
Making sense of the global economy. CNBC.
I strive to be intellectually ambitious. I want to be making connections, finding the right data so I can help our viewers see around corners. I'm based in Los Angeles, and talking to VC investors or Hollywood executives, I have a unique perspective on what's going on in this incredibly fast-changing world. I love being a business reporter. In covering technology, I'm reporting on change. Ambition can create change.